Hey, Mitchell with Option Wolf here. Today we're going to be going over vertical spreads. This strategy will confuse a lot of beginners, but once you get the hang of it, you can basically do this stuff in your head. Vertical spreads are traded essentially as opposed to selling naked options to alleviate any risk and subsequent margin requirements. A lot of people choose to trade vertical spreads. It's a sound strategy as long as you know what you're doing. So the strategy, you're buying or selling a call or put at a different strike with the same expiration. There's two types of vertical spreads. There's a debit spread and a credit spread. A debit spread will limit your profits, but it'll also limit your premium paid. So your max loss potential is what you're paying to open that spread. The credit spread will limit your loss, but it may allow you to maximize premium received relative to your max loss. In essence, a debit spread is going to be more comparable to buying options, and a credit spread is going to be more comparable to selling options. So your max gain on these, your max gain when you open a credit spread is going to be a premium. So if you say open something up with a 5-point wing on it, you might have a $500, set aside $500 for margin and pick up $60 or whatever your premium is for which you sold it. The max gain on a debit spread is going to be inverse. It's going to be the difference between those strikes minus your debit paid. So as an example, you sell a 240, 242 put spread on SPY for 45. What's the most you can make? So in this situation, we're selling to open the 242 put and buying to open the 240 put. We made $45 on that. That's going to be our max gain. On a debit spread, you buy, let's say on a call spread, you're buying a 240 call, you're selling a 242 call, turning it into a vertical debit spread for $45. That's how much you're paying. What's the most you can make? It's going to be the difference between those strikes, which is 2 minus what you paid, 45. So your max gain there is going to be 155. Max loss on credit spreads, it's going to be the difference between your strikes minus the credit received, kind of similar to the max gain on a debit spread. And the debit spread, your max loss is going to be simply how much you paid to open the position. So here's the same example. So you sold a 240, 242 put spread on SPY for 45. What's the most you can lose there? It's going to be your difference between your strikes minus the premium you received. So it's going to be that 2 minus 45, 155. And then on the debit spread, you buy a 240, 242 call spread on SPY for 45. Same example. What's the most you can lose? What you paid for it. So break even on these. Your break even on a credit spread, it depends on whether it's a kind of put or a call, but short strike on a put minus the net credit, and then call short strike plus the net credit. And then on a debit spread, just basically the same premise with puts, long strike minus net debit, calls your long strike plus net debit. So on a call, if you are long the lower strike price, it's going to be a debit spread. And if you're short the lower, it's a credit spread, and the inverse applies to puts. So here's that same example. We're going to calculate the break even. So you sell a 240, 242 put spread on SPY for 45. What's your break even? It'll be a short strike of 242 minus that 245. 241.55 theoretically would be that price at which you would break even upon expiration. Same premise with the debit spread. You buy a 240, 242 call spread on SPY for 45. What's the break even? Just your long strike plus 45. So you're long the lower strike here, making you bullish. It's a call spread. So you take 240 plus 45, 240, 45 would be your break even there. One thing I want to mention that I think is important on these is volatility skew. So volatility is higher on lower strikes, and it affects puts more than calls, making puts more expensive. Something to be cognizant of. It's not really going to affect you too much, but just something you should have in the back of your mind. Anyway, that's our presentation on vertical spreads. If you want to know more, get into more detail, make sure you subscribe, and as always, trade safe.